Hello, welcome back to another episode of Cash Counsel. My name's Joe Cordell. You'll recall from last week that we're talking about the basics of estate planning. And I don't want to be too ambitious here in terms of what I'm trying to teach you. I only want to communicate kind of those fundamentals that will allow you to interact most effectively with your lawyer, whoever you use to do your estate planning. And I hope certainly a byproduct of this discussion is that you're going to be stimulated, galvanized, or whatever to go and do estate planning. I mean, it's the nature of it that it doesn't seem to be knocking at anyone's door. I hope that you do not hear someone knocking at this moment regarding that. I know some of us will get advance notice. I mean, we'll come down with illnesses and things like that where we'll know that there's this limited time frame to get those things done. And most of us will get those things done under those circumstances. But we all know that many times it doesn't happen that way. And as a result, what occurs in the aftermath of our lives would be something that's dramatically different from what we would have chosen. And there are other purposes of estate planning, and maybe we should start out with that topic. And we'll revisit some of the things we talked about last week, and I think that bears repeating, and we'll move forward as well. Kind of two broad areas, two concerns that people have when they decide to do estate planning. On the one hand, they're concerned about management and control of assets, meaning that they may be concerned that their wife, after their death, might make poor decisions, might be vulnerable in a second marriage. Others may be concerned about their children, whether it's the children's minority, meaning that they're being under age 18, or whether it's their personalities and maybe it's something you suspect your child will never outgrow. There's that category of concerns. So management and control is a huge area, a huge reason for doing estate planning. And then there's another category of concerns, and that relates to tax minimization. Naturally, no one wants to pay the federal or the state government, or any government for that matter, more than they have to pay. That's understandable. So by doing planning in advance, the whole idea is that you minimize the amount of money that you pay. And of course, we're not talking about pocket change. We're talking about, in the United States, 45% or so of taxes could be on the table. And we'll come to that in a little bit. So as we're talking about this, it may be that many of you fit both those reasons for doing estate planning. You do have concerns about succession, which means management and control of assets when you're not able to see to it they go to the right people, and that that the benefit of your labor is ultimately realized by your loved ones as fully as possible. Then there's that other concern related to the first, which is about minimizing taxes. Usually people that come to us, they might have a little bit more of one of those concerns than the other. Sometimes we'll have clients who we suggest they have some estate planning done because clearly they have huge tax issues, particularly in the aftermath of the divorce. And then we have those who it's just entirely management control, and it's not a tax matter at all. As a matter of fact, that the size of their estate may be such that they're not vulnerable to estate taxes. And we'll talk about those limitations here in a little bit. So whatever category you fall in, this discussion is worth having. And remember, though you may not feel a sense of urgency, there is a sense of urgency, because these issues that we talk about may be staring you directly in the face at this moment, and you're not able to recognize it. You don't know what lies around the corner for you. So let's talk about the issue of taxes for a few minutes. When we talk about taxes, we're talking about the issue of estate planning. Really, it's one of generally three types of taxes: either income taxes, gift taxes, or estate taxes. There's something else called generation skipping transfer taxes, which I'm not going to spend much time discussing because it's probably too esoteric for the time we have here, and it's not going to apply to many of you. We can start out talking about income tax. Income tax has relevance when you're doing estate planning, because some of the things you do may trigger income tax in ways that you didn't anticipate. You weren't doing it for purposes of minimizing income taxes, but you may trigger events and liability that you wouldn't have wanted to. For example, when you make a transfer to someone, can you go ahead and take money that you've earned or other assets that are in your name and transfer them to someone else, and that other person get to declare as income the future income of those assets? And generally that's true. But there's a concept that emerged shortly after the income tax code was adopted in the United States, which was in 1913, the 16th Amendment. When that was adopted in the United States, there was a lot of uncertainty about, gee, what does it mean to have an income tax? We'd had other types of taxes before, like excise taxes and certain property taxes and other things. There had been death taxes before. But income tax was a fairly new concept for America, and we see how it's mushroomed since it was first adopted. But in the early stages after the income tax code had been created, there was a lot of uncertainty as to what it meant. And there was a time when people tried a variety of things that now we recognize as clearly impermissible. There's been a whole lot of precedent that's been created where the courts have ruled on those attempts to avoid taxes. And one of the most obvious would be for someone to transfer assets to their children in the hopes that they would avoid paying taxes at their rates. For example, if someone is the highest marginal rate today, let's say a 35% tax rate, and their children are effectively in a 0% tax rate because of how low their income is, or the fact that they don't have income, it certainly would be attractive if you could take that money and gift it to your children, and then they pay all the income tax related to the earnings on that, and you're enjoying the benefits, quite frankly. You're using the money, whether it's for them or for you, it's still money that you would otherwise have been paying. So the IRS a long time ago decided that that's impermissible on a couple of bases, and one relates to the idea, this is a metaphor that was introduced by the Supreme Court decades ago, and it relates to the fruit and the tree, and the court will tax the tree, and you can't simply transfer the fruit of that tree, meaning the income from something, and argue that you have no liability because you've transferred the income to someone else. The ultimate question of the court is, what is the source of the income? The source of income will be taxed. Another famous case was one in which, this was back when you had a code where the husband and wife could be taxed separately and independently, and there wasn't the joint filing. So the husband earned the money, which he had a contract with his wife that income would belong to her. And so there was a binding contract that suggested that whenever he went to work every day, he was a lawyer in fact, not surprisingly, when he went out and worked every day and earned this money, it was going to belong to his wife. So she should be taxed, and that would have been at a much lower rate. So even though in pure terms of property law, she did own this income, the fact is that the court said the reality is that the tree is the husband. He's the one who's generating these fruits, and we're going to go to that for purposes of taxation. That concept's been applied in a variety of contexts since then. So now we see much of this codified, in fact. It's codified to the extent that we have what's called a kiddie tax. Some of you are familiar with this, and others of you perhaps have never heard of it. The kiddie tax, it simply says that anytime that children have income, unearned income, meaning it's not from a job, but it's from monies that were provided to them by their parents, then that's going to be taxed at the children's or at the parents' tax rate. So there's no advantage to giving $1 million to your child that's going to generate, say, $50,000 a year in income. That 5% would be imputed to the parents, or I think the way it's technically done, which produces the same result, is it's taxed to the children at the rate of the parents. In any case, at the end of the day, there's no monetary advantage for doing those sorts of transactions. So this discussion has an implication beyond gifts to minor children. Whenever you make transfers, if there's some retention of control of that transfer, then the court may continue to tax income to you of something that you think that you've transferred to someone else. Another context in which this comes up is what we've talked about before just briefly, and that's grantor trusts. And the IRS has what's called grantor trust rules that says that, sure, while generally if you take assets and you transfer them to someone else, then of course the income related to that would be taxed to that other person. That's the general rule. And so you can count on that except under certain circumstances. Where you've made any effort to retain some degree of control over that money, where you have the ability to determine when, for example, it's going to be paid out of a trust, if you continue to be a potential beneficiary. There are a variety of contexts or a variety of things you can do which will disqualify that transfer as being one that has income tax implications. That, in other words, once the transfer is done, you still are taxed. But again, let's go back to the fundamentals here. The fundamentals are that if you create, remember we talked about trusts as being these independent entities, and we talked about that if it's a revocable trust, then it's not a real transfer for purposes of the law, and as a result they tax it to you as if there had been no transfer.